Oh, what a year. 2021 is almost for the record books now. And as we get ready for 2022, I am wanting to provide you with my market forecast for the Las Vegas residential real estate market for the year 2022. I am Justin Miller with the Chong Miller Group. Let's go ahead and dive right in. So the first thing I want to do is I want to give a little bit of a recap of where we are. Just sort of set the playing field for where we will launch from into the new year. So 2021, right now, it's Thanksgiving weekend, the end of November. This year, we have had the highest sales volume for single-family residential resales in the Las Vegas Valley's history. So resale numbers of homes, highest ever. We also, at least on a nominal basis, have achieved through that the highest level of pricing for single-family resale homes that we've ever seen. And almost every month this year, we've actually been achieving new record prices. We started January 2021 at $340,000 median sales price, residential single-family resale. That was the same as December. We've gone up from there and we've hit records almost every month. Now, kind of interesting, I do want to point out for much of 2019, prices, the median price had been hovering at $300,000 plus or minus about $3,000, so from $297 up to $303, fluctuating in that range. Over the past couple months, August, September, October, we've been hovering right around $404,000, $405,000. We've been going up and down slightly around that. October, we ended at a record high of $407,000. We don't yet have the median numbers for November, and obviously we don't for December either. I expect we'll continue to hover right around this $400,000 level for the next 2 reporting months of 2021. What that means, though, is prices are up year to date by 19.7%. And I expect that we're going to finish 2021 year to date probably up about 19%. And again, this is with record home sales. Now, I do want to make one other comment about this price level, because $407,000 being a record price, some people are very worried about affordability. I refer you back to the affordability video I did under the Ask the Professor series a couple of months ago. We are not hitting affordability constraints as we move toward the end of 2021. And in fact, in that video and a few other times, I've talked about deflating numbers or inflating old numbers to understand how dollars compare across time. The highest record price prior to 2020 had been $314,700, and that was achieved in June of 2006, right? And clearly we're way above that now. We're what, $93,000 above that right now. But those are 2006 dollars. And we all know there's inflation that occurs every year, and inflation's been a little bit higher this year because of supply chain issues. Inflation will probably be a bit higher next year as well due to continuing supply chain disruptions associated with the pandemic. But right now, if we were to inflate at the end of November 2021, those 2006 dollars, the median sales price in June 2006 was the equivalent of $431,760. So we are still well below what were $24,760 below the median sales price from 2006. So that, if we look at the numbers that way, suggests that actually we still have higher buying power than we did in 2006. And of course, interest rates are lower as well. We'll get into those things as we go through the video. But I do want to make those particular comments. The one other comment I want to make about the market as it is in 2021, before we look forward in time, is that with our 19.7% price increase year to date, Las Vegas is not the highest priced market, nor is it the most rapidly growing market in the US. Rather, we're up in kind of the lower middle tier of the top 20 cities. And I don't mean the top fastest growing 20 cities, but rather the top 20 cities of the Case-Shiller Index, which looks at the largest metropolitan areas. And we find ourselves between 10 and 20 in terms of price appreciation. We find ourselves further along, higher up, in terms of market size growth. But that's rather interesting. It means, again, that Las Vegas is not overheating. We're in line, a little bit above the national mean, but we're in line with where prices are growing across the country. All right. So that is level setting. Now, I want to look backward for just a couple minutes to, in some manner, give additional context to the forecast that I'm going to give. And that is, I want to look back at the forecast that I did for the year of 2021. Now, I did that in December of 2020. And so I had slightly more information about 2020, but of course that year was particularly weird. And so anyhow, how did that forecast look? And how was the context within which that forecast was made? Everybody from February on in 2020, and in fact some earlier, were doom and gloom. And I'd been saying prices would go up. I was saying sales would go up. And in fact, that's what we'd seen in 2020. Well, as we got to the end of 2020, most forecasters were saying doom and gloom. Prices have gotten too high. They're above the nominal record from 2006. Prices are going to collapse. People are not going to be working at home any longer. They'll be returning to wherever, as opposed to trying to telecommute, etc., etc. I stood in contrast to that. And I said, nope, we're going to see escalating sales, and we're going to see escalating prices throughout 2021. Now, I had suggested in my forecast, based on the data that I was able to look at, including trends going into the future for various issues, some of which we'll get into today, was that I saw price appreciation increasing by 12 to 15%. Where are we coming in? We're coming in at about 19% for the year. So I was actually less optimistic than what the market turned out to be. I'd also suggested sales would increase in, again, 12 to 15% range. That would be a pretty significant increase because 2020 was a strong year for home sales. In fact, it was just about exactly tied with 2019, which had been considered a strong year. So I was forecasting significant growth on top of that, 12 to 15%. So in 2020 through November, there'd been 27,547 single-family resales that had taken place in the Valley. And through the end, almost the end of November of 2021, there's been 33,711 single-family home sales that have taken place, resales that have taken place in the Valley. This is actually 22.4% higher through the first 11 months. Now, I think that that's going to pull back some because December of 2020 was particularly strong. So all the other forecasters who were putting out videos, many of those who were writing blogs, many of those who were releasing formal reports into the marketplace were suggesting doom and gloom, or best a flat market. I suggested something quite different than that. I suggested something that was, we're going to be seeing growing market, we're going to be seeing growing prices, we're going to be seeing both of those in the 12 to 15% range. And if anything, I literally was too conservative in my forecasts. The market has outperformed even what I said. Now, Let me just pull in a couple of interesting statistics, and then we'll get into what I see for 2022. 2021 saw the greatest number of over $1 million properties transacted in the Las Vegas Valley. Now, a number of people have been talking, all these people arriving from out of state, especially California, they've got tons of cash in their pocket, they're out competing everybody here in the Valley. And so, of course, prices are going up. And of course, we've got $1 million sales taking place all over. Well, it's an interesting story. It makes for nice headlines, but it's not really all that true. So yes, there were a record number of properties transacted at 1 million or above. But the number actually averages 116 per month through the first 11 months of 2021. So it's not a massive portion of the marketplace. In fact, there were at sale price over $600,000. So including the $1 million properties, but $600,001 and above, an average of 449 transactions per month in the Las Vegas Valley. Now, that's certainly a healthy number, but that's still a fraction, a small fraction, about 15% of the 3,065 transactions that occurred average per month through the first 11 months of 2021. So it's actually 14.6% of transactions have been $600,000 or higher. Now, if you've been watching my market updates, you know that price per foot's been increasing more rapidly than median sale price. And I've suggested, and I'm suggesting it's correct, that means that the mix of properties is skewing a little bit higher, but still 600,000 and above, which is $193,000 above the median. So it's not right super expensive at $600,000. $600,000 and above, 449 per month on average through the first 11 months of this year. So, all right, the other comment or item that I want to comment about before moving into 2022. This has been big in the press recently, the written press, the TV press. There have been several statements being made all over the internet about this. And so I want to address it just briefly here. And that is Zillow. So Zillow had been a number of things. And one of the things they had been over the past couple of years has been what's referred to as an iBuyer. An iBuyer is an entity that makes instant purchase decisions for cash. The I is for instant. Some people say the I is for internet because these transactions take place in some portion over the internet. Some people probably think the I is just for decoration. There's always been investors who've been out there who've been willing to buy for cash. But the model is effectively somebody wants to sell their home. They want to sell their home quickly. They want to sell their home with a lot of convenience. Don't want to have to make repairs. Don't want to have to put a sign in the yard. Don't want to have to do showings. And so they can contact an iBuyer, or even better, they can contact a real estate agent who will contact multiple iBuyers and get cash offers for the house. And those offers will appear within generally 48 to 72 hours. And those offers may be at about market. They may be a little bit below market for the convenience that's being provided. And there are benefits of engaging in a transaction in that method. And there are significant drawbacks of engaging in a transaction in that method. But over the past few years, we've seen OfferPad, we've seen Opendoor, we've seen sometimes Redfin, and we've seen Zillow get into the iBuyer market. And there's a few others that tend to be smaller, less national in scope. Well, Zillow recently announced that they had taken a $500 million loss and they were getting out of the iBuyer market entirely. And there have been a lot of people who've been saying this is because Zillow found themselves with a lot of properties at a time they think that Zillow thinks, the market's going to collapse. And they just want to get out before they can't get out. They want to get rid of these properties, and they definitely don't want to take on more. I think that's a complete misunderstanding of what's gone on with the Zillow iBuyer program and why Zillow is getting out of the market. Zillow has been, in some very real manner, the number one aggregator of real estate information, at least real estate real-time market information, over the past decade. They have, in some manner, allowed for individuals to go out and find data that had previously been almost impossible for individual people to find. You'd have to invest a lot of time and effort. You'd have to talk to a lot of individual real estate agents to try to accumulate the kind of data about a very specific market and maybe the properties in that market to get what Zillow could tell you pretty quickly by doing some online searches. And so Zillow has come to dominate this information space. Now, Zillow information is not as good as the information that a knowledgeable real estate agent can get for you for a variety of reasons, but it's really good information. It's much better than what had existed out there previously. But that's what Zillow did. Zillow was an information aggregator. They collected information from all around the market through a variety of means, mostly automated. And they put that information together and created a website around which people could search for that information. How did Zillow make money? Well, like most information providers, Zillow made money by providing subscriptions and by selling advertising. And so we advertise, Chong Miller Group advertises on Zillow. We're premier agents with Zillow. And that means that if somebody is viewing a property on Zillow and they click on that property, they want to learn more about it, because we're an advertiser on Zillow, you might connect to us. You might connect to any of the other advertisers who are on Zillow. And so real estate agents paid Zillow a fee to advertise on Zillow to all of those people who might be looking at the information that was there. And that was their business model. And it was a very successful business model. And it's a tried and true business model. And remember, I used to be a business school professor. I taught entrepreneurship. A lot of that is about creating business models. And a business model in brief is the ways in which you're going to make money and the monies you need to expend in order to have that money be available to be made for you. And so newspapers, they sell advertising and they sell subscriptions. Right? It's a tried and true method, business model of engaging in business. Well, Zillow decided they wanted to be more than just an information broker and a connector in the marketplace. That starts to create a lot of interesting problems, antitrust type problems. So one of the wealthiest people in the country, well-known name, is Mike Bloomberg. Mike Bloomberg did a similar thing with the financial markets, and he created what's known as Bloomberg Information, Bloomberg News. He created these computer terminals, the Bloomberg terminals, that people can have on their desks and be looking at real-time information about the market and search for whatever other real-time information they want about the market. Now, Mike Bloomberg made a fortune, literally a fortune, by aggregating and selling access to this information, making the information all public. There's nothing at all illegal about that activity. It actually, in some manner, made the markets more efficient because more people could get access to information more quickly, so that information silos weren't existing where some people had private information that they could trade on to the detriment of other people. So it's a fantastic business model and a great service to the particular marketplace. What would have happened if Mike Bloomberg decided, in addition to this, he wanted to also open his own brokerage, and he was going to maybe preferentially use the data that he was getting in the marketplace to trade on behalf of his clients? And then what would have happened if he decided to compete with his clients and he wanted to preferentially trade on behalf of himself or his company? Well, there'd be all sorts of antitrust claims filed against Bloomberg, right? We see this kind of thing where an entity decides, I'm sitting on something of real value and other people are taking advantage of it and I want to take advantage of it myself preferentially. I think Zillow started running into antitrust problems, and the antitrust problems actually are more extensive than what I'm alluding to here. Zillow has been very aggressively participating in this market space. In 2020, when the economy locked down, Zillow and a couple of the other iBuyers immediately exited the market. While claiming they provided liquidity, they actually pulled out of the market entirely, preventing sales from concluding, right, being actually distressing actors into the marketplace. They'd moved back in when the economy opened and people started clearly wanting to buy and sell homes. But that type of activity, the pulling out and then going back in, says they're not actually a market maker. They're not actually providing liquidity into the market, and they're actually taking advantage of their market share and their information dominance to potentially harm other market participants. And so I think that Zillow has exited the iBuyer market in front of real legal liability around antitrust issues. And so I think that's what it is. I think this is a Zillow-specific issue. I don't think this is going to be specifically impacting other iBuyers. Now, to the extent that Zillow may have been paying too much on some of the purchases they were making, then yes, other iBuyers in competition may also have been paying too much. And so we see potentially decreased earnings with other iBuyers for a little while. But those are small hiccups in the growth of the revenue streams of those companies, as opposed to interesting information about what's actually taking place in the residential real estate market. I don't think that we have any kind of insight from Zillow exiting the iBuyer market as to the market slowing, the market stalling, the market collapsing, or anything else like that. I think that people who want to speak doom and gloom are latching onto something for the wrong reason to interpret data in the incorrect way. Anyhow, that's my comment about Zillow. Hi, I'm Justin Miller, and we are the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes, and we specialize in helping you, our clients. If you're not yet one of our clients, reach out to us. Give us a call, send us an email. Let's see what we can do for you. And now back to the show. So those are some interesting tidbits about the market. Over 1 million, record high, 116 a month average. Over 600,000, record high, 449 average per month. In a marketplace that's actually transacting 3,065 average resale residential single family homes per month, 14.6%. And that is a record high number of transactions taking place in the What specifically I'm projecting continued low inventory. In fact, I think that in Q1 of 2022, we're going to have acute inventory crises as we did in Q1 of 2021. I think that moderates maybe substantially, more rapidly and more significantly in Q2 and Q3 of 2022 than what we'd seen this year. So I think that Q1, we're going to see some challenges in terms of number of unit sales. I think we're going to see some more significantly escalating prices in the first quarter of 2022 than we may through the rest of the year. Of course, seasonally, Q2 is the strongest quarter, and so we'll still see low inventory, even if not acutely low inventory issues in the second quarter. And so we'll see increasing prices going through the second quarter of 2022 as well. Why do I say 12 to 15% price growth on top of the records that we've had almost every month in 2021? Remember, we're still 6.1% below today's inflation-adjusted levels from 2006. So that gives us significant room to run on the upside before we actually, in real dollar terms, even hit the record prices that we'd seen in 2006. So that's room to run. So what are the specific reasons that I'm making this forecast? Why am I optimistic about the market looking forward? Well, let's break these things into a couple different categories. The first issue is mortgage money. So one, interest rates remain low. They remain historically low. Over the past couple of months, interest rates have started creeping up a little bit to about 3.25%, 3.3%, but they've actually, over the past 2 weeks, been coming back down closer to 3%. Median nationally for 30-year flat rate mortgage, constant rate mortgage. So that's one thing. Interest rates are historically low. As interest rates go higher, they make a house at the same dollar cost more expensive on a monthly basis. Historically, what we see is interest rates start to go higher, that people come into the market to lock in lower interest rates than if they were waiting around. But I think that we're actually going to be seeing interest rates continuing near historic lows between 3 and 3.5% for most of the year 2022. And at 3.5%, they are still at levels that prior to 2020 were seen really only in 2 years for less than a quarter in each of those 2 years in the historical duration of the US housing market with 30-year mortgage loans. So very low interest rates. The second thing is conforming loan limits have increased. So a conforming loan is a loan of a particular dollar level or below that meets certain other criteria, but is immediately insurable by the federal entities that insure residential mortgages. When you're buying a property and borrowing money above the conforming loan limit, you're using a jumbo loan. And jumbo loans sometimes are harder to get, sometimes are of higher interest rates, not always, but generally speaking. And so the conforming loan limit allows one to get a conventional mortgage, and that's actually, it makes things easier for the buyer. Well, the conforming loan limit for 2022 has been increased to $625,000. So it's an increase of well over $100,000. So a 20% down or an 80% loan to value property with the maximum conforming loan would actually allow you to buy a property of just over $780,000. So $780,000, 20% down, just less than $160,000, about $156,000, leaves you with a loan, 8% loan to value of $625,000. Well, that's a lot, right? That's actually really a lot. So $780,000, remember, $600,000 and above in price in Las Vegas this year, there's only 449 of those selling every month on average, at less than 15% to be at $600,000. So we're looking at something considerably less than 10%, probably less than 8% of the market would allow us to still have conforming conventional loans. That's big. That's a significant potential accelerant into the market. As well, VA loan limits have effectively been eliminated. So not all lenders will give you unlimited money on a VA loan, but the VA has for practical effect, now said that VA loans can be used on properties of any value. And so if you're a veteran or you're active duty, you don't have to worry about this issue any longer. Of course, you still have your qualifying issues such as debt to income ratio and or the VA's equivalent. It's a different calculation. It's not called DTI, but the kind of VA equivalent of it. Obviously, the property has to appraise and the property has to be in good condition and etc. But you could buy a $3 million property on a VA loan now in 2022. So So active duty and veteran members who want to use their VA benefit will help, again, accelerate the market. And this is not taking into account potential first-time home buyer funds being released by the federal government or by other local governments or banking entities for CRA compliance over the next year. So in some manner, the availability of mortgage money is increasing, and it's increasing in a productive manner that will help to support the market and in fact help to grow the market. I'll also point out there's a lack of inventory associated with mortgages. So in other words, foreclosures remain very low. In fact, according to recent Black Knight data, foreclosures are extremely low, and properties in distress are decreasing. If you take out those with loan forbearances, properties that are in distress are actually decreasing even more rapidly. And so those with forbearance are being allowed workouts, which allow for those deferred payments to actually be placed at the end of the 30-year mortgage. So that does not put additional burden onto homeowners who'd taken forbearance. And so we're not going to see a foreclosure wave coming in. So both sides of the mortgage market are operating now in support of growth of the market. All right, that's great, as long as there are people who want to buy. Are there people who want to buy? Yes, there are a couple demographic trends that I want to talk about. One is the Millennial Generation. So lots of things get said about millennials. Good things, bad things. They're going to dominate everything, blah, blah, blah. The reality is, though, millennials are the largest generation in American history. They're a little bit larger than the baby boomer generation. And millennials over the past couple years, but especially 2021, have started to establish their own households. The millennial generation is interesting in that they are behind in terms of age at which they're starting to do this, but they've started to do it in significant percentages in 2021. So that means, in the stereotype, they're moving out of their parents' basement and they're buying their own house, right? In reality, they weren't in their basements in Las Vegas and et cetera, but they're starting to establish their own households and they're demanding housing. And oftentimes that demand for housing is looking like purchase demand as opposed to rental demand. And so part of this is millennials are starting to buy where they had been renting. Millennials are starting to move away from roommate situations to establish their own households, whether that's as an individual or as a family grouping of some type. And so that's creating significant demand. We also have baby boomers aging in place. And oftentimes that means that baby boomers are needing to move into maybe smaller houses or single-story houses. And so they're starting in 2021 to be recognizing the needs to move in ways they'd been prevented from doing so in 2020. And this is a trend that will continue as baby boomers right size, allowing for move-up sales for families that are growing and need bigger spaces. There's another demographic issue, and that is migration trends. Las Vegas is clearly an in-migration destination. There are people who leave, but it's dwarfed by the number of people who arrive into Las Vegas. Las Vegas continues to be one of the fastest growing large metropolitan areas in the country. And that is because people are coming here for retirement. And it's also because people are coming here for jobs, because Las Vegas is actually a job engine. And so this is a structural issue that we'll get to in a couple minutes. But in reality, jobs are growing here in the Valley, and they're actually diversifying some in the Valley as well. And that's pulling people here, people who have income, whether it's fixed income from Social Security and retirement benefits, or income associated with employment. And they're coming here to the Valley. And so that creates additional demand. We've got demand from people who are here, who are in place, moving into single family houses for the first time in their lives. as owners, or changing the type of house they're living in, and we have in-migration demographic patterns which are bringing additional demand, and those continue. They continue unabated, and in fact, they may very well be accelerating as we go through 2022. There are also some structural issues that are supporting the housing market. One is the rental market. Rental rates have been increasing, and increasing at a faster rate than housing mortgage payment rates. So if you're renting, your rent rate is going up and it's becoming more expensive to rent than it is to actually own a home. In fact, it's demonstrably in Las Vegas more expensive to rent than to own a comparable property. And so the increasing level of rents is also inducing additional people to search for and buy housing, assuming, of course, they've got some ability to qualify for a loan. And there are programs that will help people qualify for loans. You can get conventional mortgages with as little as 5% down. There are ways to deal with those issues. I'll also note that if you're renting, you're in an environment where you do not control your housing costs. Your landlord may say, I decided I no longer want to rent to you, you have to leave. That could happen. But even more likely, landlord says, I need to increase your rent. And then a year later, I need to increase your rent again. And a year later, again, I'm going to be increasing your rent. May not happen, but it certainly could. Landlords within their right to do that. Is the market continues to support higher rental rates, landlords are likely to increase their rents. Well, if you own a home and you have a fixed rate mortgage, you know every month for 30 years what your mortgage costs you, plus or minus a few dollars because of differences in escrow funding fees. So that means that your housing cost is stable when you're an owner, whereas it's not stable if you're a renter. As a renter, you're looking at variable and increasing housing costs year in and year out. Okay, so what else? Increasing employment levels. Now, there's two ways to look at this. We have decreasing levels of unemployment. Unemployment was very high during the pandemic-induced economic closures here in the Las Vegas Valley. Those unemployment levels have come down considerably. They're still higher than they had been pre-pandemic, but they're also still continuing to come down. But while we've got the unemployment side of that equation, and those people who are long-term unemployed right now have largely run out of unemployment benefits. And so it's a significant issue for those who continue to be unemployed. But we also have increasing levels of employment. And part of the increasing levels of employment is there are more businesses that are moving here that are opening up new facilities, or existing businesses opening new facilities, and they need to employ more people. And so we have the economy, the economic driver of the economy, employment, growing. At the same time, we also have decreasing unemployment, meaning the economy, the jobs are increasing at an even more rapid pace. So in 2022, we will have more jobs and lower unemployment than we had in 2021. As we are here in November of 2021, we have more people working today than we had a year ago in November of 2020. And so as we get additional job growth, additional entrance into the employment base, as well as decreasing levels of unemployment, and consequently those people moving back into the employed status, that's supportive of the housing market. People who are employed are more likely to be able to buy houses than people who are unemployed, or people who do not participate in the employment economy. I'm Justin Miller with the Chong Miller Group. I produce these videos to put valuable real estate information into the public domain. If you find these videos to be interesting, helpful, or have usable content, please subscribe to our YouTube channel. And as they say in the YouTube universe, please smash the like button. That way I'll know to continue to produce videos like this. Thank you. And now back to our show. We also see increasing numbers of conventions, CES, presumably, at least as announced, they're going to be coming back this in 2022. As conventions come back, that means that we have more people coming into the market, spending into the Las Vegas Valley, spending money in hotels, in resorts, in bars, in restaurants, in all of the kinds of places that are the dominant portions of the economy where people make money. Of course, they also need more lawyers, they need more doctors and dentists, and maybe more real estate agents and accountants, and there are more car dealers, and etc. All of those other things that are growing more rapidly than the leisure economy here in Las Vegas is actually growing. We're seeing, as of the beginning of November 2021, the November 8th, the return of international air travel. And I don't think that's going to happen super quickly for a variety of reasons. But on November 8th, we had a Virgin Atlantic flight come in from London with a little over 250 people. And over the next several months, we're going to see more and more of the international air travel returning to Las Vegas. And that's significant because not only do international tourists spend more money here and go to conventions at a higher rate percentage-wise than domestic travelers, but we also see in some of the submarkets, such as high-rise residential condos on the Strip, that the international visitor is significant to that market, not because they're buying the majority, but because they're the marginal buyer many times in that particular market segment, and that then spills over to the rest of the housing market. And we see, of course, pandemic-driven demand for alternative housing and work environments. And some people have started suggesting that, hey, those who are working remotely, working from home, teleworking, they're going to start to see increasing levels of unemployment. I don't buy that at all. We're going to start to see significant formalized hybrid work environments where some people will work remotely for a few days a week. They'll work locally in office for a day a week. Las Vegas, to the extent that it's highly connected, easily accessible to markets around here, allows for that kind of commuting super easily. And I say that as somebody who, as a professor, when I was a professor at the Marshall School of Business at USC, I lived in Las Vegas and I commuted to LA every week. It's a simple commute, right? It may not be the kind of thing you want to do for 20 years, but doing it for a few years, really simple. You hop on a plane and an hour and a half later, right, door to door, you're there. You hop in your car, 3.5 hours later, you're there. And so Las Vegas, being as connected as it is through the airport, potentially maybe one day with high-speed rail, it's a relatively easy city to live in from which to commute. So people may have found they need pools, or they need bigger yards, or they need more bedrooms, a home office. People are finding their current living environment may not be exactly what they need, and they've got the wherewithal to be able to actually find more closely what they're wanting. And that, of course, frees up housing for others to move into the existing housing stock that had been occupied. So all of those structural, demographic, and monetary reasons are the reasons that I believe the housing market in Las Vegas will continue to grow throughout 2022, and we're going to be seeing that same kind of 12 to 15% price appreciation and growth that I had suggested for 2021. Now, could it be higher? It could be, but we tend to see in cyclical environments a regression to the mean, and so I could forecast a little bit more. I want to be conservative here, but I actually think that my estimates in the 12 to 15% range are conservative. Now, are there any negatives out there? Are there things that could interfere? Yeah, sure. Always. So one of the things is pandemic-related international travel. So just this weekend, we've seen the Omicron variant of the COVID-19 virus, SARS-CoV-2, announced by the WHO as being a variant of concern. the highest level of recognition that something may need to be done. We've seen the US clamp down on international travel less than a month after international travel was reopened to prevent visitors coming from, I believe it's 8 countries right now. Much of Europe has shut down travel from various areas. We're seeing confirmed cases of the Omicron variant of COVID-19 in multiple countries in Africa, multiple countries in the Middle East, and now multiple countries in Europe. So the question is, with the Omicron variant, is it resistant to the vaccine and therefore of heightened level of concern? There is, of course, the question as to whether or not things could shut down again. And on the one hand, that sounds extremely unlikely. On the other hand, Eastern Europe, we're seeing shutdowns across multiple countries right now. Those shutdowns are spreading into Central Europe, in the Netherlands and in Belgium, potentially into Germany. We're seeing Hong Kong being significantly impacted at this time, the time I'm doing this video. So here we are, literally 2 years into the COVID-19 pandemic world, and we're not through this. So could there be additional dislocations? Yes. But I will point out, we've seen how Las Vegas real estate has done in the face of these same pandemic conditions, and that is actually growth. So while this would be a negative, a clear, unambiguous negative for the housing market, the impact is differential, and I don't see that as significantly negatively impacting the housing market here in the Las Vegas Valley. Now, it could decrease numbers of transactions for a transitory period of time, but it's not going to be causing prices to collapse. It's just simply not going to happen. What else? The other potential negative, affordability. Again, I recommend you go back and you watch my Ask the Professor video on affordability that I did earlier in 2021, where I looked for you at not just the nominal and real dollar prices for housing, but the mortgage-based payment streams for housing, given that interest rates are so low, and found that actually earlier in 2021, housing prices are running just over half of what they were in 2006. So I know that there, as I said in that video, there are always people who cannot afford housing. And that's a feature of the market, and we can have a really interesting and valid discussion as to whether or not it's a good feature or a bad feature of the marketplace. But it's a feature of the market as the market is structurally designed at this point in time. And so while there are those who have housing challenges, the reality for the median person in Las Vegas, and the majority of the people in Las Vegas, is housing is more affordable now, still, even with the higher prices that we see today relative to the beginning of 2021, more affordable today than it was in 2005 or 2006, or frankly in 2007. And even with increasing prices in 2022, that'll still be the case, because remember, just to get back to the real dollar figure, not the mortgage monthly payment figure, but the real dollar figure for a purchase of a price, we are $23,000 below that right now, $21,670 below that right now. So those are my forecasts. I am Justin Miller with the Chong Miller Group. We are a Las Vegas-based residential real estate team, and we help buyers and sellers. If you find this video to be helpful, please subscribe. If you find this to be interesting or engaging in any manner, please, as they say on YouTube, smash the like button so other people will have a greater chance of finding this particular content. And please reach out to us if you need any help in the real estate market. We would love to represent you as buyers. We would love to represent you as sellers. And we are here. You've got our phone number, our email address, And we look forward to talking with you soon. Thank you.